Welcome to the Explainer. Right now, the financial markets are, well, they're sending some really mixed signals. It's creating a ton of uncertainty out there. So today, we're going to cut right through all that noise. We'll break down the key data points to give you a much clearer picture of what's actually going on. All right, let's jump right in. This recent volatility has everybody asking the same thing, especially about Bitcoin. Is this the end of the bull market, a permanent goodbye, or is this just a temporary little pullback, more of a see you later?
So to really figure this out, we've got to look at both sides of the coin. Let's start with the case for caution. The bearish arguments. There are really two big ones floating around that suggest this downturn could be the real deal.
Okay, so these are the two big bearish arguments we're hearing. First, that quantum computing is a threat, and second, that major central banks are tightening up their monetary policy. Now, these two ideas are fueling a lot of the anxiety we're seeing, but let's break them down, because honestly, one of these is a much bigger deal than the other.
Let's tackle that first one, quantum computing. Honestly, this argument just doesn't hold much water. Think about it. If quantum computing was a real, immediate threat to Bitcoin's encryption, wouldn't it be an even bigger threat to the entire traditional financial system? I mean, banks, stock markets, they all rely on similar security. And we're just not seeing that kind of panic priced into the wider markets. So let's set that one aside for now.
Okay, so that brings us to the much stronger argument, the one we really need to pay attention to. And that's the idea that central banks are tightening monetary policy. The story goes that they're pulling money out of the system, and when that happens, it puts a ton of pressure on riskier assets, like stocks and, of course, Bitcoin. And if you look at Japan and Europe, you can totally see why this argument is so popular. The data seems to back it up. Just look at the 10-year bond yields in both regions. They're in a clear uptrend. That's like a textbook signal that their central banks are tightening the screws, taking a more restrictive stance. In other words, they're pulling money out of the market.
But here's the million-dollar question, right? Is that the whole story? Are we just looking at one piece of a much, much bigger puzzle? Because, well, when you zoom out and look at the global picture, things start to look very, very different.
And this table just lays it out perfectly. This is the global liquidity tug of war. Yes, on one side, you've got the Bank of Japan and the European Central Bank pulling back. They're being restrictive. But on the other side, you have the two biggest players on the field, the People's Bank of China and the U.S. Federal Reserve. And they are doing the exact opposite. They are pushing money in. They're expansive.
Let's take a quick look at China. Their economy's been underperforming a bit, so what's their central bank doing? They're injecting liquidity to try and stimulate growth. And you can see the proof right there in their 10-year bond yields. They're in a clear downtrend, which is a classic signal of an expansive or easy money policy.
Meanwhile, over in the United States, something pretty radical has happened. We've seen a complete policy shift. I mean a total 180, and it happened fast.
Get this, the Fed, which was pulling liquidity out of the system, has completely pivoted. Now they're injecting $40 billion per month. And that's not all. The U.S. Treasury is also getting in on the act, injecting an extra $78 billion into the system from its general account. It's a double whammy of stimulus.
So you do the math. $40 billion from the Fed, $78 billion from the Treasury. That's $128 billion, a staggering amount of new liquidity being pumped in every single month from U.S. sources alone. This isn't a small change. This completely flips the script on that global liquidity is contracting narrative.
Okay, so with that much money being injected, it has to be going somewhere, right? The evidence should be showing up in the markets. So let's follow the money and see what other major assets are telling us.
And, yep, there it is. The proof is right there in the pudding. Gold, it's knocking on the door of all-time highs. What about the stock market? The broader indices like the equal-weight S&P 500 and the Russell 2000 have already broken past their previous all-time highs. Now, this is absolutely not what you would expect to see if money was tight. So what about Bitcoin? Well, it's incredibly sensitive to these liquidity flows, but historically there's a lag, about 90 days or so, and that could very well explain its recent performance. And this really gets to the heart of the matter. The argument that liquidity is contracting is just, well, it's incomplete. It's a classic case of cherry-picking the data that fits a bearish story. You have to combine all the factors. You can't just look at Europe and Japan and ignore the absolute fire hose of money coming from the US and China.
So this brings us to a new financial reality and a really fundamental question. Why is this happening? I mean, the U.S. economy is growing at over 3%. According to all the old textbooks, this is the exact opposite of what the Fed and Treasury should be doing. So what gives?
Well, the answer seems to lie in a massive paradigm shift that took place right after the 2008 financial crisis. Before 2008, things were pretty straightforward. U.S. public debt and economic growth, or GDP, they basically moved together. But then 2008 hit. And after that shock to the system, you can see U.S. public debt just takes off. It starts growing exponentially, completely leaving the actual growth of the economy in the dust.
And this huge gap, this divergence, has created what some are calling a new paradigm: central bank capitulation. What does that mean? It means the central bank isn't really independent anymore. Its monetary policy is now being dictated by the government's massive need to finance its soaring debt. They're almost forced to print money, to inject liquidity, just so the government can keep the lights on and sell its bonds.
So here's the really provocative thought to leave you with. In a world where government debt just keeps climbing, have central banks lost their independence for good? Is what we're seeing from the Fed and the Treasury not just a temporary policy choice, but a permanent new reality, a new feature of our financial world where the money printer has to keep running just to service the debt? It's a pretty big question to think about.